Terrific traders, welcome out to your FOMC meeting. It is November 1st. The year is flying right past us. And let's go into what we're going to cover here today.
Disclaimer. This video was created for professional Forex and crypto traders. Maverick Currencies is a proprietary trading firm that employs professional traders around the world. Our traders trade firm capital and keep 70 to 80% of profits they generate. All trades and analysis in this video are for professional traders only. If you are interested in becoming a professional Forex and currency trader for Maverick, click the apply button in the video description. Let's break down what happened today.
As we look at things like this, we've got to think about statistics, and standard deviations or expectations for moves are basically based on history. So if you think about how much an asset tends to move, what are its tendencies, well, then we can calculate that. We can turn it into a mathematical formula. And so going into an event like this, there's a few things that we know. Number one, the asset will move more than it normally does, right? There will be a little uptick in volatility. If it's 1 hour ATR is that it usually moves 15 pips, well, on a Fed meeting, it might move 25, 30, 35, depending on how much energy is in that move, that meeting. So we expect asset volatility. We expect an uptick. But importantly, the market already knows that this event is coming. That's one thing that we're going to anticipate. Number two, when you're going into an event like this, you have to think about what's already factored in, what's already priced in, right? And priced in might be a better term. What's already priced into the move. So if we're looking at the US dollar, which obviously we're focused on into this Fed meeting, when something is priced in, what does that mean? Well, it might be heavily already guided to a certain outcome, meaning the Fed might have already said, hey, we're not going to raise rates. There's 0% chance that we're going to raise rates. So that's already priced into the market. Everybody knows that. Sometimes it might be a little more up in the air. It could be 50-50 as to whether the Fed's going to hike. It could be 25-75. So it's not fully priced in. It's not already factored into the way that the asset is trading. And so we need to think about that as well. What's already priced in? What is not priced in? Whenever you're in an event like this, you have to think about the actual statement release, and then you also have to think about what comes after. And what comes after is an actual press conference. And these can be two entirely different things in terms of the movement. In other words, the statement could create one reaction. The press conference could fuel that further, or what has been happening for quite some time now has been a complete reversal of whatever that first move was. You know, imagine the US dollar spikes up on the statement, the press conference brings it back down. Imagine that it falls on the statement, the press conference brings it back up. For whatever reason, right now, these are diverging paths. And I think logically that sort of makes sense as well when you're thinking about this in terms of, you know, why is an asset moving the way that it is? So let's come in, and if we come into the website here and we just look at, let's zoom in here. So here's the Fed funds. Here's been the trend. And you can see that in looking at this trend, the trend has been for interest rates to be hiked. We always say that central banks go on trends. They don't hike one meeting and then immediately cut the next and then hike back up and then cut. They don't go back and forth. They go for a while, and usually there's a pause in between. So it might be that they're in a rate hiking cycle, and then they'll pause for a period of time before they start to cut. And then they pause for a period of time before they start to hike. And so before we ever get into interest rate cuts, it's highly likely that there will be a pause and some flattening out here before we move into an interest cutting cycle. And if they start to cut interest rates, it's probably not just going to be one. It's probably again, usually these things trend for a while. So one cut is followed by 2 and 3 and 4. And the question becomes, once you enter a rate cutting cycle, you're trying to figure out, okay, how far do they have to go? Is this going to go from 5.5 all the way back down to 2.5? Or is it only going to go to 3.5? And we have to think about these things to determine how much should be priced in. But as one would expect, usually when there's a turn in their way of doing things, when they change policy and go from a pause to a cut, you have to price in multiple cuts. And usually this is where there's big currency moves, is at the corners, right? When they've been in a hiking cycle and then they stop. When they've been in a pause and now they start to cut. When they've been in a pause and now they start to hike. When they've been in a hike and now they start to pause, usually you get some pretty big reactions. And certainly when the Fed starts to cut in the future, that would be big. Now, the question that the market has is, are we entering into a pause cycle? That's what the market's really trying to figure out, is where are we at? Is the Fed still going to have to hike rates a few more times? Are they going to pause for a while? And the odds, if you look at the percentage, there's a 0% chance they hike at this meeting, but it's gone all the way down to about 25% chance that they hike at the next one. Now that's a big drop in probability. So the market is starting to price in and expect a flattening of interest rates. I've been saying this for months now, that that's not my viewpoint. My viewpoint is a little different than that. I've given this analogy where the Fed is like a golfer that just dumped one in the water. They have to club up. They have to make sure that they don't screw up the same way, and they have to get it over the water, right? So they have to do something because they messed up previously, and if they're going to err, they're going to err on the side of overdoing it, not underdoing it again. In other words, they screwed up inflation so bad that they have to combat that. They can't keep getting that wrong. If it means that they go a little too far, that they raise rates too far, that they don't cut soon enough, whatever it may be, their big objective right now is to really slow down inflation, to get it back to where they want it to be or close to it. And that's their number one goal. They screwed up once. They can't afford to just keep hitting it into the water and screwing up on that same thing. So I think the whole higher for longer, like I've been on record as saying, I think that's a real thing. So I'm not so sure that they pause here. I would almost go the other route and think that they're going to have to hike a couple more times before this thing's all said and done. Now, if my theory is right, then the US dollar should be a beneficiary of that. I really have two possible trades, and today's Fed meeting is not so much geared up towards all of that fundamental thought process, but I'm looking at Kiwi USD. So if I want to play the US dollar lower today, I think I want to buy Kiwi USD. It's got a little mini cup and handle or ascending triangle, whatever you want to call it. I'm interested in buying Kiwi USD. That's not a pair that I trade often necessarily, but this is what I'm going to play if I want to get short US dollars. If I think the US dollar is going to weaken a bit further today, I'm going to go long Kiwi USD. Now on the flip side, look at this pairing. Whoops, put it in backwards. Should have just used my other screen here. If I look at dollar CAD on the flip side, this thing is up potentially on the cusp of breaking out to the upside. So if I want to get long US dollar, I actually want to play this. So long dollar CAD, I'm buying this one. Okay, we're buying this pair to play USD to the upside. Or Kiwi USD, I'm going to buy, and that would get me playing US dollar to the downside. Those are the two pairs, and they're somewhat, offset. Like a lot of times they'll move together, so it's sort of one versus the other, I'm essentially saying I think the US dollar, if it's going to go up, should perform here in the near term versus CAD more than other currencies. And if it goes down, I think the Kiwi is going to be one that holds up better than most. And that's a little bit of a shift from some prior things that I liked. I mean, I liked energy for some time. I liked CAD on the back of that, but I feel like that's changed here in the past week or two. Energy is not as exciting for me personally right here, right now. CAD's not exciting on the upside. I'm actually going to look at that a little bit more on the downside just right here, right now. So those are my possible trades. Now, I always like to get some orders ready, meaning like I would slap and I usually put it above just so even if it's running higher, I have a better chance of getting filled. Whatever you're trading, your 3 lots, 5 lots, 10 lots, whatever. And then I would usually attach at least a stop loss. Maybe not a bracket order, maybe not a target, but I would at least put a stop loss somewhere in there to know what my risks are. Now, if we look at this from the standpoint of risk to reward, I just put in a hypothetical 30 pip stop, and you can see where your stop loss is. I can grab this stop and I can drag it wherever I want. And we can just kind of snap it into place somewhere in here. And I'm going to call it 138.71. So this hypothetical trade of long dollar CAD would get us in the neighborhood in terms of risk, would get us risk of about 26 pips, basically, is the way it's set up. And if this thing's running higher, we can achieve at least that, if not more than that, I would suspect. You can do the same thing with Kiwi CAD, have some orders triggered. I'm going to be trading not on this screen directly, so this is just hypothetical, but I would have something similar to that. Now, here's what happens. If this starts to shoot higher, we may even want that price just a little bit higher, in that I'm willing to pay up a little on this one. I'm going to move it to 39.02, but I'm willing to pay up a little bit. If this has some energy and burst to the upside, I'll trigger my buy order, and then if it backs up just for a split second, if it backs back into that price, my order executes. Now, if it runs away from me, well, I don't get an execution, but I would rather, and by the way, if it backs up and we trigger an order and it's below this price, imagine it's trading at 138.97 when we trigger this. Well, we'll get 138.97. We won't pay our high price. We'll pay this price or anything lower. So this is like setting your max price, and it's a way to quickly hit transmit and get that order out there almost instantaneously, and that's going to help you to get a quick execution rather than having to come in, set up your buy order, set up your stop loss, start to trigger the order. You want to have something that you have quick access to. Now, we should see this right here, right now, running about 1,000,000 miles per hour, and the knee-jerk reaction is not energetic. It's kind of slow, and it's down. It's US dollar moving lower, so we'd actually be more inclined to head over here and play Kiwi USD to the upside. And I still like this pairing, I have to say. It's not a real energetic move, but I would be okay playing this because I think that we've got a pretty decent risk to reward here. Let me attach a stop, and we'll put in that stop just a few pips below. Nothing too major. And probably drag that down just a touch. And we'd be looking at trading something like this in terms of Kiwi USD towards an upside play. At least back up to the top of the range, puts you at 58.60 or so. And I think that's a pretty good risk to reward. Now, if I look over here, we've got our buy at 58.32. It would have well, we've got pause. That's why it's not moving. Oh, that's the damnable misery of this. The the Kiwi goes into its 15-minute spell here where it's not trading. So we got a little issue there. I forgot about the timing of Kiwi. This is when, as you know, if you've traded in FX, there's a little end of day reset for a few minutes. Well, Kiwi pairs are in that right now. So we wouldn't be able to transmit that. But we can come back over. And I was wondering why it wasn't doing that based on how US dollar is trading on the others. It's a little choppy, and I don't know that we would, again, there's not a lot of energy, but I would be a little bit more inclined maybe to play that Kiwi USD possibly. But we can take a little look here at dollar CAD. I certainly wouldn't have my buy order up there anymore. We could really squeeze this down, and if we wanted to get in, we could get in at a much better price here at 138.84 or something like that. But that would be the issue is, you can see US dollars going down. If you were long Kiwi USD, you'd be the beneficiary of this, right? Kiwi USD would have reverse, kind of triggered one of those orders you had out there, and now would be working in the direction we expected. But we've got that little 15-minute window to deal with here where it's going to be stagnant and not moving. So based on all the other pairs, this certainly would have triggered an entry price. And I wouldn't transmit this to where it's just live immediately when the market reopens, but it would be the pairing that I would be inclined to look at. Now, if Kiwi USD reopens here after its down period and it's trading down below this level, of course we're not going to transmit the order. But if it's somewhere in here in the 58.30s, let's put it at 58.30-ish, somewhere around there or above, I'd be more inclined to trigger. If it's trading well down here, I'd be far less inclined. Risk to reward wise, we have it set up at only 10 pips of potential risk, so not a real risky proposition either way. And I do have to say this Fed meeting was a little bit of a dud when it comes to energy of the move, right? We like to see a big burst, a really excitedly sharp move in the assets that tells us there's momentum and there's all this, backstopping it. And right now we really don't have that. So you're not in any hurry. Make sure that your risk, your rewards, your probabilities, those things really match up before transmitting that order. The flip side of that is if we come back, we know that what has been the tendency is there's the statement, and then 30 minutes later, there's the press conference. And so we're going to have to deal with Fed Chair Powell speaking here in about 25 minutes. And my guess is that he's going to have to continue with the dominant theme, which has been, hey, we're fighting inflation. That's our first goal. We don't think we're done yet. We're just data dependent. He's going to stay on that message. And that may get the markets thinking that more rate hikes are coming, that, the Fed's not certain they're done and so forth. If it's going to skew the trend and the probabilities at all, my tendency would be to think that it's going to skew them in the direction of more rate hikes, not fewer. I don't think they're going to come in at this meeting and just be outright dovish and saying, hey, we're done, we've beat it, inflation's down, and we've succeeded. That's not going to be the message at all. In fact, inflation's ticked back up, as we know, the past couple of months. So they still have some work cut out for them, and I would continue, as I've been saying for the past number of months, I would continue to bet higher for longer that the Fed has more work to do, even up here at 5.5. I don't think their job is done. So, either of those pairings, let's come back to USD CAD because that's really the one that's trading around. And there's clearly not the breakdown of sorts. Can there be more back and fill here? Certainly possible. You can see there was actually a Bollinger Band set up, and it indeed traded up to the upper end of the range and the upper band, so a little short-term trade that would have worked there for buying. I still, if you want to get long dollar CAD, and that's not a terrible philosophy given my viewpoint on what the Fed Chair Powell is going to speak, then I think you want to keep it more in this range of, buying here at 138.83, stop at, 15, 20 pips below, something like that, not too much risk. And you're playing this up into the probably 30, 40 pips higher as a short-term trade. Something like that, I think, makes more sense on the long side. And I thought we'd be over. Frankly, I thought it would be kind of a quick trade, get in, get out before the Fed Chair Powell even speaks. This is my currency pair of preference for Fed Chair Powell's press conference. I would rather be long US dollar in his press conference, feeling like he has much, much higher probability of speaking hawkishly, of giving the market some feeling that more interest rates or hikes are coming versus less of them. Those things should be good for the US dollar. So this is the better pair for that second trade, the press conference trade. But that's still, 22 minutes away. So the first trade is working. The damnable misery of it is this is when the Kiwi goes dark every day. And so we're not really participating. But anyway, we'll leave it there. Again, I think in about 20 minutes or so, you could start to look back at long US dollar CAD, that pairing where I think being long USD into the Fed Chair Powell's speaking and press conference makes more sense to me. So thanks everyone for joining us. Have a great rest of your day. We will be back again this week on Friday for a live non-farm payrolls class. Have a great rest of your day. We'll see you next time.